Hi there. Welcome to Commodities. I'm Lindsay Biscaya. Let's take a look at how some of the key commodities are trading today. We will begin with energy. Oil is surging again as Iran has listed energy targets that it could target as retaliation to some U.S. and Israeli attacks on its energy assets this morning. So you can see oil is up more than 1% at the moment. Gasoline down at the moment. Natural gas is up, though, almost 3% throughout the day. If we take a look at where some of the metals are trading today, we saw gold surging or dropping rather for a sixth straight day today. It's down by more than 3%. This is actually its longest streak of decline since 2024 due to those surging energy prices and hotter than expected inflation numbers coming out of the U.S. today, those PPI numbers. Silver following suit, of course, down almost 5%, and copper is down almost 4% at the moment. And here's some stories we're watching for today. Trans Mountain is planning a series of expansion projects for its main pipeline. The government-owned company says this will allow crude oil to flow faster and tankers to carry more volume by 2027. Trans Mountain says it already exports 60% of crude exported by tankers to Asia, adding the war in the Middle East and the U.S. military action in Venezuela are making the pipeline more valuable. U.S. President Donald Trump is waiving the Jones Act for 60 days. The federal law requires ships moving goods between all U.S. ports to be built, owned, and crewed by U.S. citizens. The White House says this measure will mitigate short-term disruptions to oil prices. This announcement comes as attacks across the Middle East continue to target energy infrastructure. And so we're going to dive into that further. For more on the Jones Act and the road ahead for oil prices, let's bring in Bob McNally, founder and president of Rapidan Energy Group. It's good to have you join us. Thanks so much.
Thank you for having me, Lindsay.
So the idea of waiving this act, does this policy response move the needle at all, do you think?
It's a good idea. It moves the needle a little bit. But to be honest, in a world in which we've lost 15% of our oil, 20% of our natural gas, it's not much of a needle move, I'm afraid.
Because that's what I was going to get you to explain is how would waiving this act actually help to stabilize the oil market, and particularly, hopefully, I guess the end result would be oil prices for the U.S.?
I think the way to think about it is the Jones Act makes it more expensive for Americans living on the coasts, the East Coast of the United States and the West Coast, to import gasoline and diesel. Why? Because you can't export all that gasoline and diesel that we make in the Gulf Coast and export to other places. You can't send it from an American port to an American port unless you're using an American crude and built ship, and there aren't many of those. So what it does is it forces the East Coast and California to pay more for gasoline and diesel from further away, like Asia and Europe. So by waiving it, suddenly now New York can import from Texas on any old boat, a foreign boat, and that makes it a little bit cheaper. So it's worth pennies off the price. It's not nothing, but in the context of the price increases we're seeing now, Lindsay, these days, it's not much of a needle move, I'm afraid.
What would need to happen to see that needle move further, other than maybe like a ceasefire?
Yeah, no, the sad reality is the disruption of Hormuz presents a math problem, just a volume. It's the largest disruption in oil history, twice as big as the last one. We simply can't offset the loss of 15 million barrels a day of crude and products. We went down from 20 down to 5 by sending some crude out to the western part of Saudi Arabia. So we did a little bit, but we just don't have policies that can offset that size of a loss. The only thing that's going to solve this is reopening Hormuz to commercial traffic.
We've seen crude prices rising yet again today after attacks on Iran this morning and Iran bracing for potential retaliation. Does this introduce a new geopolitical risk premium to prices that we have not previously seen, this waiving of the Jones Act?
Not so much the Jones Act, but the attack you mentioned certainly does. So far, both sides have refrained from targeting each other's critical energy infrastructure. There are facilities that have not yet been touched, that if they were touched, as bad as these oil prices have been, and natural gas prices, and LNG, I should say, they will go much higher. So Iran has been attacking critical Emirati facilities, and now the U.S. and Israel attacked a critical Iranian gas facility, largest gas field, but it's processing facilities. So what we see is a tit for tat escalation that risks eroding that restraint. And if we get to the point where everybody's going after their vulnerable, critical facilities, then even if we have Hormuz open in weeks from now or months, we may have lasting damage. That would be deeply unfortunate. And today, the market is starting to price that in.
We know Jeff Curry of Carlyle has stated that the oil market is significantly underpricing the Iran supply shock. I'm wondering, I take your point, that it's starting to be priced in. Would you agree with that assessment?
Totally. We modeled this Hormuz conflict last June. We had weeks of disruption. In a best case scenario, we were probably too optimistic. When I would mention this to people before the conflict started at energy conferences, they thought I was high on substances that are illegal in the United States to consume. They said, you're nuts. There's no way the United States is going to allow Hormuz to be closed by more than 2 days. It's like a load-bearing assumption in economics. So absolutely, it is taking a while for folks. I talk with traders now, even today, they're still believing that tomorrow there's going to be a taco or something like that, that this will all be over. I think they're wrong. It takes a while for load-bearing assumptions, foundational beliefs in the market to erode. So yeah, no question, that's actually limiting the price increases, this sort of reservoir of market hope that it'll be over soon.
Right, because as you say, you're starting to see more priced into the market. So as every day kind of trickles on and we see this conflict continuing, you can expect to see maybe prices increase. Is that what you're thinking?
That's right. That's right, Lindsay. And we're also going to start to see physical shortages. So far, it's mainly been a price issue, right? Prices are up over 50% for crude. In the United States, almost 30% for products at the pump, gasoline. But now we're going to start to see in Asia and Europe now acute shortages. Diesel, gas oil is now well over $5 a gallon in the United States. That's very high. India needs that LPG. Refiners are starting to reduce runs. So as we start to see the physical shortages manifest themselves, because we've been drawing down these inventories that have been built up on the water, some sanctioned barrels, et cetera, that's when it's going to start to dawn on the market that this is starting to have real physical impacts. It's not getting resolved anytime soon. Unfortunately, if we don't find a way to open that straight, I think we have a lot higher to go in price.
We're seeing Iran today, listing energy targets that it could target in response to some U.S. and Israeli airstrikes of its energy assets over the last day or so. If that were to happen, how much worse could this situation get? And would that maybe, open the door for more attacks on some of Iran's real key energy assets?
Well, one of the targets that Iran listed is a big refinery in Yanbu, which is on the west coast, which is where that one redirect we talked about, that it's about a 7 million barrel a day capacity pipeline called the East-West Pipeline. It's the only way to get significant amounts of barrels out from the Gulf. That terminates there, and there's a refinery there that Iran listed that uses that pipeline. So if it were struck, if we started to see strikes in Yanbu on the west coast, I think you'd see a lot higher prices because traders would realize, oh no, the one redirect route that we had, as little as it was, might be in danger. And so it would be another leg up in prices, I'm afraid.
Okay, we will leave it there. Bob McNally, founder and president of Rapidan Energy Group. Appreciate your time. Thanks so much for joining us.
Thank you.
Coming up, Canopy Growth has completed its takeover of MTL Cannabis. So what's next for the company? We will talk about that with the CEO after the break. Canopy Growth has officially completed its acquisition of MTL Cannabis. It's a move that creates what the company calls Canada's leading medical cannabis platform. So joining us now to break down what this means for the industry is the CEO of Canopy Growth, Luc Mongeau, and he joins us in the studio. Thanks for being here.
Good afternoon.
So this is pretty exciting. I'm wondering, why is further expansion into the medical space the right pivot for Canopy Growth?
Yeah, we're very excited about this acquisition. For us, medical cannabis is extremely important. Why is it important? Because it provides tremendous benefits for medical patients across Canada, veterans, for example. It is a segment of the cannabis industry that is a bit more stable, but it comes with a higher set of regulation. So imagine the product are pharmaceutical grade, so it really drives the organization to have superior level of performance, superior norms, processes, and everything. And for us, becoming number one in Canada, obviously it comes with financial benefits, but it's going to allow us to provide superior service, care, and products for veterans and for patients who really rely on cannabis to improve their lives.
There is a shift, correct me if I'm wrong, in this industry in Canada away from like just recreational use of cannabis towards medicinal use. Is that right? Are you seeing more of that?
Well, both sides are doing extremely well. And what we're seeing is more and more Canadians and actually more and more consumers around the world are turning to cannabis as an alternate source of care or an alternate source away from alcohol. The new generations, we've all seen the reports, consume less alcohol and they turn to cannabis for recreational use.
I know Canada exported more than $350 million in pharmaceutical-grade cannabis last year. So what kind of gives Canada this edge over some of the other global competition?
I mean, we've been at this for many years. The regulations in Canada are relatively high, which really drives the licensed producers in Canada to produce really high-quality products. So for us, we're really excited with the acquisition of NTL because NTL is known as one of the best grower in Canada, very high-quality products, which will position Canopy to really accelerate growth in the international market, especially in Europe.
Even though more countries are kind of ramping up domestic production, you feel confident that Canada still has that upper step and that your company has that kind of higher level?
Absolutely. I was talking to regulators and to distributors in Germany yesterday, and we're saying that, there are many entries coming from other markets around the world at cheaper prices, but they do not meet the level of quality and consistency that's achieved in Canada right now.
Interesting. So if you're looking at other countries, particularly in Europe, I think you said, what countries, is there any specific countries that you're looking at that have more demand?
Yeah, absolutely. The German market is growing extremely fast. The Poland market and the UK market is opening as well. It's all medical business. So for us, that's why, the acquisition of NTL and get access to superior quality flower will really allow us to double down on our growth efforts in these geographies.
What about expansion into the U.S.? What does that look like at the moment?
Well, the U.S. market, as you know, is limited right now. And there's a lot of rumors of when. It's no longer if. So we know it's going to happen. It's when.
In other states, you mean?
No, when they will open up the market and deregulate the market. So for us, what's important at Canopy is we've got significant investments in the U.S. We've got investment in Canopy USA. We've got a limited investment in TerraSense. So we're well positioned to benefit when the U.S. market opens up.
Do you know, I know you maybe don't know exactly, but a rough timeline of when you're hoping maybe that market will open up?
I won't speculate on that. There's a lot of rumors out there. For us, what's really important is that we put the right basis in the U.S. so that when it opens up, when it deregulates, we're well positioned to grow there.
And we know Prime Minister Mark Carney, he set that ambitious goal to double Canada's non-U.S. exports within the next decade, so kind of looking away from the U.S. How do you think your industry and your company fits into that?
Well, to what you said earlier, the Canadian cannabis industry grows extremely good quality flower with very high standard, and that flower is in high demand across the world. So everything that can be done to ease up the regulations that are put on the Canadian LPs to really allow us to be able to be more profitable, to reinvest our business, to increase production. All these will allow us to win globally. Canada really has an opportunity to be the global exporter of cannabis, the largest in the world.
Wow. Let's talk a little bit more about this acquisition now that it's complete. How does that work? How do the two companies merge together with employees and all that? I mean, is that all finalized and done?
Yeah, we're very excited. And the transaction closed on Monday. Obviously, we've been working on the integration plan for a while now. The main focus right now is really ensuring that we've got continuity and that the both businesses continue to work and be reliable and provide superior service. So we started integration on Monday morning. We've got a very solid plan, and we plan on delivering significant synergies over the course of the next 18 months.
Interesting. Okay, well, appreciate you coming in. Thanks so much for joining us.
Thank you so much.
Yeah. That was the CEO of Canopy Growth, Luc Mongeau, joining us in studio. Up next, shares of Novamont Graphite are trading lower today after that company announced it secured a commitment letter for $335 million in senior secured project debt to fund construction and development of its Phase 2 mine in Quebec. We're back in a moment with more on that. Novamont Graphite has secured a commitment letter for $335 million in senior secured project debt to fund the construction and development of its Phase 2 Matawini mine in Quebec. Now, this project was added to the fast-track list by the Carney government in November as part of efforts to advance critical mineral development in Canada. So let's bring in Eric Desaulniers, founder, president, and chief executive officer of Novamont Graphite. It's good to have you join us, sir. Thanks so much.
Thanks for having me, Lindsay.
How significant is this $335 million debt commitment when it comes to actually getting this mine to a final investment decision?
Yeah, obviously, after 4 years of hard work with Export Development Canada, the Canadian Infrastructure Bank, this is really the news that we needed to have to complete the conversation with strategic investor, that some are already invested in the project since a long time, others are coming in. So we needed to have this debt confirmation to move forward with the equity strategic conversation we're having.
And you've described this project as shovel ready. So what risks have been removed at this point to get it to the point of being shovel ready?
Yeah, so we received the full decree on the project in 2021. We have since December last year or 2 years ago, our impact benefit agreement with the First Nation of Manawan, very important partner in the project. We have 80% of detail engineering done on the project. Over 50% of the CapEx contracts are now signed, and everybody is standby to launch construction this spring. So a lot of de-risking was made since discovery in 2015.
Is it construction ready to go this spring based on a decision, or is that just regardless, it's ready to go this spring?
Yeah, so now next step, we need to complete the project finance. So now that we have the debt in hand, next step is really to secure the equity contribution from strategics and a little bit from the public as well. And once it's all completed, the team is already today on site, ready to prepare last final touch before launching construction and take advantage of the seasonality. Yeah? So in Canada, it's important to do the most we can during the good season. And now snow is starting to melt at the project site. So hopefully in May, we can be full blown in construction there.
Okay, got it. Now, with 75% of production committed through offtake agreements, how much certainty does this provide regarding future revenues and your ability to actually remain competitive with countries like China?
Absolutely. So that's super important in critical minerals to have the customer invested in the project and providing long-term certainty on the top line. So 3 market segments we're covering with the offtake. The first is lithium-ion battery. We have Panasonic Energy committed for about a quarter of the Matawini mine production will be transformed into active anode material for their plants in the U.S. Second big market, refractory bricks with Traxys, where we make the product for refractory bricks in the steel foundries. So Traxys is an important trader in there. And then everything else, about 20 different applications, including defense sector, is covered by an offtake with the Canadian government and G7 countries for about 30,000 tons of the production. So with those in hand, we cover all different aspects, all different markets to have a top line that is secured to investor of about $34 US per ton of average pricing we expect to have on the project based on those offtake, while our cost projection is about $419. So if you look, we are super competitive against China and against any other mining project in Africa or any other countries. And it's the only significant mine that's being developed in the G7 countries. So very strategic timing for the importance of that critical minerals for many sectors, including defense and battery and other vital part of our economy.
And this project has been labeled as a project of national interest. I assume that would help your company in terms of getting that final decision. But what does that mean, like in practical terms of execution and support to get that final decision?
In practical mean, right after this interview, I have another meeting. Every day I'm talking with the major project office to make sure not only the government give all the approval and have all the coordination necessary to close this project, but also to make the major project office is also very helpful at making sure we don't forget anything. They have a project expert on their side. They want to review anything in terms of resource allocated to the project, execution strategy, all of that. So for us, it's a good one-stop shop who really know about project. They all comes from the private sector. So it's a very credible source for us to help talking to the different department of the federal government. So for us, it's a very good initiative from the Carney government to establish such an expert office within the government who can very be helpful on both sides to talk to each other. Yeah.
You touched on, how this positions Canada in terms of having more access to critical minerals and being more self-reliant. But in terms of the battery supply chain, how does your company help to position Canada in a better position, I guess, for that?
Yeah, so there's a few reasons why our project in the battery supply chain specifically, we will be very competitive. First, we discuss about the competitiveness of our mining project. And it's a miracle that 2 hours drive from that mining project, there's large industrial complex like the Bécancour Industrial Park, where we have one of the cheapest and cleanest electricity source in the world, and very good capacity there to transform the product into active anode material. We have all the reagents right there to establish a low-cost C1 cash cost. That's super important to be competitive to manufacture this product for Panasonic that really needs it now right there. So, and all the other G7 countries are pretty active as well at developing their own facility in cell making. And that's where Canada in graphite anode material will be very competitive, and we can be a good partner for all the different allied countries who need diversification from China, but without significant cost increase.
Yeah. Okay, yeah. Exciting stuff. We'll have to leave it there. Eric Designier, founder, president, and chief executive officer of Nouvamont Graphite. Appreciate you joining us. Thank you.
Thank you very much.
And thanks for watching Commodities today. You can email your story ideas to commodities@bnnbloomberg.ca. Morella Fernandez is up next with the close.